Starting with your next payment, the one that lands on July 29th, three things change at the same time for your old age security and your GIS. And I need you to hear this part clearly, because at least one of these three can quietly cut your check or wipe out your GIS completely, and there will not be a single letter in the mail warning you that it's coming. It just happens. One of them looks like good news on the surface, a raise, and I'm going to show you why. For a lot of you it isn't. The second one is the one that genuinely frightens me for the lowest income seniors watching, because it can strip away a benefit you rely on because of something you did last year and have completely forgotten about. And the third quietly decides how much of your pension the government is allowed to take back. None of this is a scandal, and by the end I'm going to settle every bit of the worry. But you deserve to understand exactly what's landing on that July check, because the people it hurts most are the ones who never saw it coming. So, stay with me. My name is Jake Morrison, and for 15 years I worked inside Canada's retirement, tax, and benefits system. The pensions, the paperwork, the rules that quietly govern a senior's money. I am not a financial advisor, and I'm not here to frighten you. What I do on this channel is take the rules that are written to be missed and lay them out in plain English so that nothing about your own money ever catches you off guard. And these three changes are exactly the kind of thing that's written to be missed. So, let's start with the first one, because it's Discover More language learning app psychology video player customization, the one that sounds like a gift. Every 3 months in January, April, July, and October, the government is supposed to adjust old age security to keep up with the cost of living measured by inflation. And for this July, that adjustment is 1.2%, so the maximum old age security pension goes up. For those of you aged 65 to 74, it rises to about $751.97 a month, and for those 75 and over to about $827.17. And your GIS, the Guaranteed Income Supplement, gets that same 1.2% bump on top. Now, that sounds like a raise, and technically it is. Back, let me tell you what 1.2% actually means in your hand. For most of you, it's somewhere around $8 or $9 more a month. $8 or $9. And here's the quiet problem with it, the part nobody frames for you, the things you actually spend that money on: your groceries, your rent, your heating, your prescriptions. For a lot of seniors, those have gone up by more than 1.2% this year. So, the number on the check goes up while what it can actually buy stands still or slips backward. That's the first thing I want you to understand. This raise is real, but it is small, and it is not keeping you whole. And, as you'll see in a minute, that same small bump can even nudge some of you closer to a line where the government starts taking money back. And I want to be fair here, because I'm never going to sell you outrage that isn't true. The reason this adjustment can feel so thin is the way it's measured. People looks backward at an official basket of goods, a national average of everything people buy from electronics to airfare to clothing, and it moves that whole basket forward by the average. But that's not your basket. A senior's real basket is heavier on the things that have climbed the fastest: food, rent, home heating, insurance, medication, and lighter on the things that have barely moved or fallen. So, the official inflation number can say 1.2% for the quarter, while your personal cost of living rose by noticeably more. It isn't that the government is lying to you, it's that the average was never built to describe your life. And that gap, small as it looks in a single quarter, is exactly why so many seniors feel like they're quietly falling behind even in the years they technically got a raise. So, don't let the word increase put you to sleep, because the other two changes are the ones with real teeth. Which brings me to the second change, and this is the one I most need you to hear, because it is the one that blindsides good, honest, low-income seniors every single July, and almost nobody talks about it. Here it is. Every July, Service Canada does not just pay your GIS, it recalculates it, and it recalculates it based on the income you reported on your tax return for the previous year. So, the GIS you start receiving on that July 29th check is based on your 2025 income. Now, why does that matter so much? Because GIS is a benefit for low-income seniors, and it shrinks as your income goes up. So, if something happened last year in 2025 that pushed your income up, even for one single moment, your GIS can be cut this July, and it can be cut for a full 12 months, all the way to next July, even if your income has already dropped right back down to normal. Let me make that real, because it's too important to leave abstract. Picture a woman, I'll call her Margaret, 72 years old in Hamilton, Ontario. Margaret lives on her old age security, her GIS, and a small CPP. Her income is low, so she gets close to the full GIS, and honestly, she needs every dollar of it. Now, last year in 2025, Margaret's roof started leaking, and she had to fix it. So, she took a one-time $18,000 withdrawal out of her RRSP to pay for it. Completely sensible. Her own money for a real repair. But, here's what that did. That $18,000 counts as income on her 2025 tax return. And this July, when Service Canada recalculates her GIS based on that return, it sees a big jump in her income, and it slashes her GIS accordingly. Maybe it cuts it by hundreds of dollars a month. Maybe, if the withdrawal was large enough, it wipes it out entirely. And the cruelest part? Margaret's income this year is right back to normal. The roof is fixed. That $18,000 was a one-time thing. But, because the GIS looks backward at last year's return, she loses the benefit for the next 12 months anyway, for money she doesn't even have anymore. And it isn't just RRSP withdrawals. Anything that pushed your 2025 income up can do this. Starting your CPP or a workplace pension partway through the year. Selling a cottage or stocks or a second property and triggering a capital gain. A severance payment. Cashing in an investment. Any of those one-time events can spike the income on last year's return, and any of them can quietly cut this July's GIS. Cheese comes down by roughly 50 cents for every dollar of other income you had, so it doesn't take an enormous amount to do real damage. Now, here's the part that turns this from frightening into manageable, because I never leave you with just the fear. If your GIS gets cut this July because of a one-time bump in last year's income, you are not stuck. There is a specific thing you can do. You can go to Service Canada and tell them that your income this year is going to be much lower than last year's because that one-time event is over, and ask them to rebase your GIS on your estimated current year income instead. There is a form for exactly this. It's called the Statement of Estimated Income, and its number is IST 3041. That single step can restore the GIS you should be getting based on the income you actually have now, instead of leaving you punished all year for a roof repair you already paid for. Most people have no idea that option exists. Now, you do. And there's one more piece of this second change that I cannot let you miss because it's the one that hits the hardest, and it's the most avoidable of all. To get that July recalculation done, Service Canada needs your tax return. So, if you have not filed your 2025 tax return, your GIS, and in some cases your old age security along with it, can be suspended, stopped. Not because you did anything wrong, but simply because the paperwork that lets them calculate your benefit isn't there. You have seen seniors lose months of GIS for the sole reason that they thought my income so low, I don't even need to file. You do need to file, even if you owe nothing, even if you made almost nothing. Filing that return is the thing that keeps your GIS flowing. So, if you take one action from this entire video, let it be this. If your 2025 return isn't filed yet, file it, even now, even late, because that return is what protects your benefit. Now, the third change. This one is about the other end. It's about those of you with a bit more income, and it decides how much of your old age security the government claws back. It's officially called the OAS recovery tax, but everyone knows it as the clawback. It is how it works. Once your income for the year climbs above a certain threshold, the government starts taking back your old age security, 15 cents for every single dollar you earn above that line. And for the period running from this July 2026 through to June of 2027, that threshold is $93,454. So, above $93,454 of income, your OAS starts getting pulled back 15 cents on the dollar. And if your income is high enough, above about $152,000 for those 65 to 74, or about $158,000 for those 75 and up, your old age security is clawed back completely. Every dollar of it gone. And just like the GIS recalculation, this clawback is based on your income from last year, your 2025 return. So, the same thing applies. A big one-time event last year, selling a property, a large RRF withdrawal, cashing out an investment, can push you over that $93,000 line and cost you a chunk of your OAS for the whole year, even if your income is normally well below it. And here's why more and more ordinary seniors are getting caught by this every year, when they never used to be. As you get older, the government forces you to withdraw a bigger and bigger percentage out of your RRF every year. Those mandatory minimum withdrawals climb with age, and they count as income. Add in pensions that get indexed upward, add in CPP, and more seniors quietly drift over that threshold without ever feeling wealthy. This isn't a tax on the rich anymore. It reaches well into the middle. Let me make it real, the same way I did with Margaret, because a number on a screen never lands the way a person does. Picture a man, I'll call him David, 74 years old, at near London, Ontario. David is not wealthy. He lives on his OAS, his CPP, and a modest pension. In a normal year, his income sits comfortably below any clawback line. He's never given it a second thought. But last year, in 2025, David finally sold a small rental property he'd owned for decades. It was time. It was tired of being a landlord. That sale triggered a large capital gain, a one-time thing, the reward for 30 years of holding it, and it landed on his 2025 tax return. So this July, when the government looks at that return, David's income for the year is way up over that $93,000 line, purely because of that single sale. The result, his old age security gets clawed back 15 cents on every dollar he went over. And if the gain was big enough, it can be pulled back almost entirely for the year. David isn't rich. He had one good day selling one property, and the system treats that one day as if it were his new normal. That's who the clawback actually catches now, not tycoons, but ordinary seniors having the single biggest financial moment of their retirement. Now, there are legitimate, completely legal ways to soften this, and I want you to know they exist. Though as always, this is the point where a good accountant earns their fee for your specific situation. Pension income splitting, where you move some of your eligible pension income onto your lower income spouse's return, can bring you back under the line. Drawing from your TFSA rather than your RRF for a big expense can help because TFSA withdrawals don't count as income at all. And simply timing a large RRF withdrawal or the sale of a property, spreading it across 2 years instead of taking it all in one, can keep you under that threshold in any single year. You don't have to master all of that today. You just have to know the line exists, $93,454 before you make a big financial move this year, so you can check where it puts you. So let me put the three of them together for a second because they interact, and that's the part that really catches people. This July, your OAS ticks up a token 1.2%. At the very same time, your GIS is recalculated on last year's income and can be cut or wiped out by a one-time bump you've forgotten about. And the clawback thresholds decide how much of your OAS gets pulled back, again based on last year's income. All three land on the same July 29th check. All three quietly hinge on the income you reported for 2025. Which is exactly why that tax return, filing it accurately is the single thread running through all of this. Now, let me keep my promise from the start and settle the fear because I don't want you carrying any panic out of this video. None of these three changes is a punishment and none of them is a sign that anything has gone wrong. This is simply the system doing what it's designed to do, adjusting for inflation and retesting benefits against income the way it does every single year. It has always worked this way. The only reason it hurts people is that nobody explains it to them, so they get blindsided instead of prepared. And the difference between a senior who gets blindsided and a senior who sails through it is not money. It's knowing. It's understanding that July is recalculation month, that it all looks at last year's return, and that there are specific steps you can take if it goes against you. That's the whole game. The rule was never the danger. Not knowing the rule is. And let me steady you one more way by telling you what does not change this July because I don't want you walking away thinking the ground is shifting under everything. If your income was normal and steady last year, just your pension, your CPP, your usual small amounts, your GIS is not going to suddenly vanish. The July recalculation only bites when last year's income actually jumped. If you're nowhere near $93,000, the clawback has nothing to do with you. You can forget it entirely. Your OAS itself isn't being cut. Your CPP isn't being touched. And the age you started your pension isn't being clawed back. For the majority of seniors watching this, whose income is low and steady, the honest summary is you'll get that small 1.2% bump. Your GIS will carry on, And none of the scary parts apply. The two changes with teeth are aimed at one specific thing, a big unusual jump in last year's income, and if that didn't happen to you, you can breathe out. This video is your early warning for the year it does happen, not a reason to lose sleep over the year it didn't. And before I give you the simple steps that take the worry out of all this, let me mention one quick thing because so many of you have asked me to put everything in one place. Every rule I cover on this channel, the numbers, the thresholds, the deadlines, the exact forms like that estimated income form and the plain words to use when you're on the phone with Service Canada, I've put into one plain English guide called the Canadian Seniors Money Playbook. It's written for a real person, not a bureaucrat, so you can actually sit down and use it. It's the same guidance I'd give my own parents. If you want it, the link is in the description below, but everything you need to take the first step is right here in this video. Now, here's exactly what to do. First and above everything else, file your 2025 tax return, and if it isn't done yet, do it now, even if it's late. That one return is what keeps your GIS and your OAS flowing and what sets your clawback correctly. Skipping it is how you get your benefits suspended. Second, if your GIS gets cut this July because of a one-time income event last year, a RF withdrawal, a sale, a severance, don't just accept it. Call Service Canada and ask about estimating your current year income on that statement of estimated income form so your GIS can be rebased on what you actually earn now. Third, before you make any big financial move this year, a large RF withdrawal, selling a property, cashing in an investment, check where it puts you against that $93,454 clawback line and against your GIS. Sometimes just splitting it across 2 years saves you thousands. Fourth, if you have a spouse, look into pension income splitting and where you can draw from your TFSA instead of your RRF for big one-time costs because TFSA money doesn't count against you. And fifth, don't be lulled by that 1.2% raise. It's real, but it's small. Plan your year around the two changes that actually move the needle, the GIS recalculation and the clawback, not the $8. Let me bring it home because I want this to stick with you. Starting with your July 29th payment, 3 things change. Your OAS goes up a token 1.2% real, but small. Your GIS is recalculated on last year's income, which means a one-time bump in 2025 can cut it or wipe it out for a full year. And if you haven't filed, it can be suspended entirely. And the clawback thresholds, starting at $93,454, decide how much of your OAS gets pulled back, again on last year's income. 3 changes, 1 July check, all of them hanging on the tax return you filed for last year. But none of it is an investigation, none of it is a punishment, and every bit of it is something you can plan around once you know it's there. Because here's the truth of it. The system that pays your pension isn't going to sit you down and explain how it can quietly take some of it back. It just runs in the background and leaves you to either understand it or be caught out by it. The most powerful thing you can do is exactly what you're doing right now. Knowing what changes in July, knowing it all looks at last year's return, and walking into this year with your eyes open because you understand the rules better than the letter that never came to warn you. If this helped you, and I hope it genuinely did, do 2 things for me. Take a look at the pinned comment in the description where I've left the key numbers and dates written out so they're there when you need them. And subscribe because every week I break down another one of these rules in plain English so that nothing about your own money ever catches you by surprise. I'm Jake Morrison. Look after yourselves, keep an eye on that July check, and I'll see you in the next one.